Hello everyone, welcome to this month's Shadow MPC for the North East of England. Normal meeting for us this month, having a little bit of a discussion about how kind of the macroeconomic environment's affecting our different sectors, and then a bit of a discussion around where we think bank base rates should move in January, and then a vote as well as to what we think the MPC should do with bank base rate. So to kick things off, I'll move across now to Paul to kind of talk about your sector.
Yeah, thanks Chris. Paul Gibson of Active Chartered Financial Planners. I just want to start talking a little bit about the economic data that's been coming out of recent weeks and months, because I feel it's showing a couple of different signals. For example, employment, I was looking at some stats over the weekend, is now at an all-time high with nearly 33 million people in a job. That's 76% of the public or the nation aged between 16 and 64. So normally that would show us a sign that the economy is overheating and a potential need to raise interest rates. However, when looking at GDP stats, from the year ending 12 months to November, GDP rose by only 0.6%, and in November alone in isolation, it's a 0.3% reduction. So again, the standard response to that is that we should be potentially looking at lower interest rates to encourage growth. But the main problem is the data that we get is out of date when we get it. So if we do rewind to November, we've been debating for 3 years Brexit and what could happen there. The election was going to be too tight to call, and there was lots of fear and uncertainty. So to be fair, no wonder spending wasn't rising as it normally would do. Fast forward to today, and I do feel that some of that uncertainty has been lifted. For one, we know what government we're going to have for the next 5 years, and second of all, we know what direction they're looking to take, particularly around Brexit. We know we're leaving the EU, and more that will come out. I think particularly through the middle of this year, we will certainly know more from then. However, the other thing I'd like to quickly comment on is inflation. CPI is falling to 1.3%, which is obviously much lower than the target of 2% the government set. And I think this is now becoming part of a longer term pattern that the economy is starting to stall. So we could require a cut in interest rates to avoid outright deflation. Again, particularly in my industry, deflation is not good. It reduces the incentive for people to spend today because prices are going to be low tomorrow, and that can drag the economy backwards. So what does that mean for actives, clients and investments and pensions and people that are investing for the longer term? Well, 2018 was quite a poor year for returns. So 12 months ago from today, I was sat here a little bit worried about Brexit, what was going to be happening moving forward. We had the US coming out with statements saying that they were going to raise interest rates by 0.75% through 2019. And this started to hit public confidence. Markets fell quite sharply in quarter one of 2019. It hit investment and it pushed down economic growth. However, through 2019, what actually happened is interest rates were cut by 0.75% in the US, and the ECB also cut rates from 0.4 to minus 0.5%. What happened? Markets rose, as did investment, and so did consumer confidence. So a lot of our clients, most clients experienced very, very high returns on investments and pensions, far higher than what was predicted. And again, I think 2020 is going to be a very, very interesting year to see what happens. So for a confident economy, we should consider a rate cut just to make sure we don't fall out of sync with the rest of the world. So let's not forget we've not moved rates for a long time, where the rest of the world has been starting to reduce those rates. That said, it does come with a bit of caution that any cut in rates is only a short-term fix. But the potential of Brexit, if it does get unleashed, the UK does get unleashed and we do drive forward, we'll have plenty of opportunity to raise interest rates, and that would be a nice problem to have.
So I think, I think there's definitely an interesting point in there, in so much as I think this is the first MPC in a very long time that we can talk about uncertainty reducing, I guess significantly as well, realistically. I think, like you say, both the certainty in both government and also kind of trajectory for Brexit, I think is, welcome from a business perspective, that uncertainty is reducing. And I think some of the confidence metrics we've seen kind of early in this year from the CPI and the PMI data has reflected that, and I think that's quite encouraging. So yeah,
Absolutely.
interesting.
Yeah.
Okay, thanks very much, Jonathan.
Yes, Jonathan Lamb from the Entrepreneurs Forum. We're talking about the link really between the economic data and confidence, and some of the factors over the last, say, 6 to 9 months have given people more confidence in the outlook for the UK economy, but also some of the trading conditions outside. I mean, the members of the forum, they tend to be quite optimistic people by nature. They tend to look at opportunities and deal with the challenges to realise those opportunities. That's pretty much always the case. But particularly over the last, say, month and a half, there's more reasons to be optimistic. The core economic data is pretty solid. You know, you've got a remit of 2% for the Bank of England. You know, it's well below that. You wouldn't want to put up the interest rates and maybe jeopardise some of the emerging export opportunities that people are now feeling more confident about exploring, not least because, you know, maybe we're on the cusp of some trade agreements around the world, and particularly in an area like the North East, which still has a strong manufacturing base, that can be highly geared around interest rates as well. So in terms of the members of the forum or exporters, there's a little bit of nervousness about an interest rate going up. The data does, as Paul's already suggested, there's unless we find something out in the next few weeks, there's no strong messages that there's about to be a bubble of overheating economy. Mm-hmm. There's no real suggestion of that. And that may be because even though people are a little bit more confident, they're not suddenly opening the purse strings business-wise or domestically, because there's still some caution in the psyche. Like I said, I wouldn't say the Entrepreneurs Forum members are known just for their caution, they're known for their optimism, but clearly business investment decisions are serious decisions, and you're looking at all the data. So in terms of a view, we have 300 plus members, and each of them have their own individual views because their individual circumstances are different in business as well. The personal circumstances and the business circumstances are different. So, for example, historically low interest rates, etc., and political uncertainty haven't stopped quite a lot of our businesses going out and seizing challenges. I think in terms of the effect of a change on business, I think that reasons to be optimistic are higher. The economic data is solid, so I think it has to be a pretty special case for making a change either way at the moment, because most of the basics seem to be right or pretty finely tuned to make a change at this moment.
So either way though, I guess before kind of the MPC kind of locked down communication ahead of their meeting later this week, there was a couple of key members coming out and talking about rate reductions. I guess since then, kind of mentions on the CPI and PMI data, the confidence metrics have been quite positive. Do you think that that's kind of made the risk of that disappeared, or just slightly less? Or do you think potentially looking at a rate reduction from them? I don't know.
I think that the rate reduction would have to be confident that wasn't going to sort of be the spark that let inflation just catch up.
Yeah.
That would be the nervousness, wouldn't it?
Absolutely. Yeah.
I don't agree with Paul about a rate reduction. I do agree with his analysis of the economy, and I do agree that a lot of the negative stuff in the economy is rear view mirror stuff. The first 10 working days of this month of January, my own business grew by between 8 and 10%. Now, it's a small business turning over just over £1 million, but it does show you that there is an appetite for people to place orders, and it's a marketing PR business. It's the kind of thing that people are wanting to market and promote their products and services. So it's at the front end of economic activity. And I noticed the IOD had a new bit of data out, the IOD's confidence tracker, which was taken after the general election, one of the few bits of data that was post December the 12th, and it showed that confidence overall in UK directors and businesses had grown from 30% being positive about the future to 46%, but in the northeast of England had grown to 71%, which is an extraordinary, and there's a lot of unique things happening in the northeast of England, which government is now looking at, and whether it be on our LEPs or because the government has reorientated its political support with more MPs in the northeast. But the issue, and I don't think there's an appetite for putting rates up yet, but I don't agree with putting them down, because there are some things that would be affected if the pound went down. For instance, it won't be missing to anyone that the price of diesel is now regularly over 130 as a result of Trump shooting that terrorist. And we buy our oil in dollars. And that is an economic, there's a lot of push on electric cars. I've been caught in the enthusiasm myself, but still the oil price does affect our economy. And there are a lot of imports, and I wouldn't like to see those imports going up in price, albeit I do take what Jonathan has said about our exports. And I think that rates are, in general terms, too low. They demonstrate a lack of confidence in the economy because they were set for an emergency, and they remain set at emergency levels. If you're on fixed incomes, if you're a pensioner, you're not getting what you need. So it's not just about business, albeit I wouldn't like to see a shock rise. I certainly don't think this month is the right time for a rise, but I have no appetite to see rates lower.
You talk about the kind of positive news within your own personal business quite early in 2020 there. Do you see that as being directly linked with some of the kind of what we've just kind of talked about, of the kind of some of the uncertainties?
Yeah, I think so. I think it's exactly what Paul's analysis was. Of the clients that we've won, and there were numerous, first they were in all different sectors, in IT, in extractive industries, in healthcare, in property. So all different sectors. And all of them had one common denominator. They had decided the beginning of this new year, this calendar new year, that the climate was different and they were going to push ahead with their plans. A lot of these plans have been put on hold. We forget now, in this new year, only 2 months ago, there was the possibility of a quite hard socialist government, which would have damped down an appetite for investment by business. And I think that my own business has seen plans being enacted, buttons being pushed, decisions being made, and I think that rising tide will lift all boats. And we'll see pay going up, we'll see employment rising further. It did actually go down in the northeast. Unemployment went up, employment went down in the 3 months to November, but I think it will turn. I'm cautiously optimistic it will.
Thanks.
Yes, Daniel Williams, Nottingham Hinks Sisters. I think in a nutshell it's obviously very unusual times. Looking at all the various indicators, what Paul said, employment is highest that it's ever been. We look at politically what's going on, which is great news for the North East, this idea of pumping more money and government spending into the North. But that's obviously going to be with a view to, I guess, increasing services and demand, and then you think about the labour market, employment's high anyway. So I think from an interest rate point of view, if you're increasing demand, you're not going to want to increase interest rates because if you're increasing demand, people are going to want to borrow more, businesses are going to want to borrow more. I take the point that Graham says about, for perhaps something for our elderly clients who have money invested at low interest rates, obviously it isn't particularly good for them and they're not particularly happy. The flip side is obviously for the younger generation it's better, as far as obviously borrowing and buying properties, which we'll see I'm sure from Dyke and Building Society. Our residential property department, they've had a very good start to the year. Speaking to them this morning, they're saying that estate agents have been very positive. They've got more instructions than they've had for a while, which seems to be good. We've had some good instructions again from a commercial property point of view as well. Private client work, which is what we do a lot of, planning and things like that. We can be affected by what the budget is, and obviously where we are at the moment, no one kind of really knows what's going to happen with the budget. What can they really tinker with? If they're going to increase spending, they're going to have to finance that spending from somewhere. Does that mean they're going to borrow more? Does it mean they're going to change rates? I think I read over the last couple of weeks things like entrepreneurs relief may be looked at to potentially sort of raise funds and pay for things. Income tax, they've been on about potentially reducing that. But ultimately, I think the budget is going to be an interesting one in March. That in turn will obviously affect interest rates, seeing how things settle. But ultimately, no one really knows what's going to happen. Yes, Brexit's, it's decided, it's great, but the big decisions are still to come. How we're actually going to exit the EU, what deals we're going to have with America, what's going on, this idea of this digital tax and all that kind of business. And, that then links what we were talking about in terms of, the rates that the business pay for premises and all that kind of stuff. And everyone's saying that needs to be reduced to help the high street, etc. But at what cost? Because local councils are then going to be lacking funds and so forth. So I think really, it's the only tool we've really got perhaps is interest rates for the time being, and I think no one really knows what the picture is yet. I think you're still a year, 2 years, 3 years away from knowing really how things are going to settle. So I think it'll be a case of just leaving things as they are and just see how things work from there.
Not for 2 or 3 years though, surely.
I don't. It's that spike, isn't it? Is there going to be an immediate spike such that you then need to raise it or reduce it? I don't know. I mean, the trade deals, how long are they going to take to be put in place? Everyone said at the outset it's going to be really quick, but in all likelihood, I think that's going to be the case.
I think you just got to look at how long Brexit's taken.
Exactly. Yeah.
I think you're right though that if we look at the tools that the MPC have available to them, you're right, it's bank base rate, it's one tool effectively that's available. We've certainly talked around the table in the past around whether there have been missed opportunities to take that rate up further than it is now, which means there'll be more, same tool maybe, but more scope within that tool, and more kind of quantum to be gone at in that. But I think without getting very inventive in your kind of monetary policy committee, it's just one tool that isn't.
Yeah, I can't see what's going to happen. Say inflation. What could cause a run in inflation in the next 6 months or a year? I don't know.
Tightening employment market. And I see the tightening employment market.
Yeah, lack of labour supply. Yeah, so increasing wages or whatever, and then maybe
trade war. US. China trade war, disruptions with the Middle East oil supply. It's not fanciful stuff. It has happened in the past. And albeit you might have a very short time period for things to worsen, it might settle back down again quickly. But you don't know that at the beginning of that, do you? That's the problem.
I think the other slightly left field dynamic that comes into this is obviously the virus that's kind of the big news in China as well, and the impact that could potentially have on the economy if that. I guess goes the direction that SARS did, would be quite a significant impact to come into it as well, potentially as well. Okay, thanks very much, Daniel.
Katrina Lingwood from Constructing Excellence in the North East, and I'm going to slightly disagree with Daniel. We have a few issues in the built environment at the moment. Obviously, the back end of last year we saw a reduction in commercial and industrial units going to projects, or to start anyway. The house builders had a slowdown as well, mainly in London and the South East. I don't think we've seen the impact up here, and I think we still have a huge housing shortage that we've got to do something about and have the right kind of houses for the right kind of people. I think we're still not supplying and demand in the right way with regard to that. The retail sector is really, really struggling, and I think obviously the spiral and rising costs with retail properties, high street. I mean, people just can't keep their businesses going. I think the properties are obviously are really struggling, and I think the high streets, although there's been so much done by many of the local authorities to regenerate the high streets, which is great, we're still seeing lots and lots of the sort of like the big retailers pulling out of many of the sort of the cities and towns in the region, which I think is really quite worrying. And I think this, the fact that Beales went last week, and it's very sad to see some of these large organisations going. I think the only upside is infrastructure. However, there's a few issues with infrastructure because we've got the review of the HS2 at the moment and what impact that's going to have. I mean, I don't know whether anybody saw the news with regard to watching the projects just not going anywhere at the moment. what's going to happen with that. That will have a huge impact effect if they decide not to carry on with that. Can't see that happening. I think it's going to go, but whether how far it's actually then going to reach HS2, I think will be another sort of thing to ask. And I think obviously the spiralling costs have had a huge effect on people's confidence with regard to that. However, when the government come in, they've said they're going to have an infrastructure project and put a lot of money into infrastructure. So I think that's a good news story, and I think that's something that's really, really positive from the new government coming in. Unfortunately, I mean, last year it was predicted that there'd be a forecast of a 7.7 increase in the construction market. It's now down to 3.4 on infrastructure, but that's still a positive story. And to me, that's something that we've got to take sort of. They're looking at the whole year of 2020. They're looking at a decline of 0.3% in construction, which isn't huge. But one of the things that's come out today and is still coming out week on week is the skills shortage. There is a huge skills shortage in the construction industry. What Brexit's going to do with that, I don't know, because obviously if you lose people from London and the South East, there'll be a knock-on effect from the rest of the UK, and that could cause an even bigger impact of what we've already got already. One of the main things is specialist skills and things like that we just can't get them, and we can't get them in the region either. And this is something that really needs to be addressed, and it's something that needs to be addressed very quickly.
Okay, thank you so much, Katrina. Graham, you've kind of
I
spoken.
think I've covered my points.
No, okay. Jonathan?
Yeah, Jonathan Willett, Henderson Insurance Brokers. So I'll start really with the insurance market. It remains rather difficult, certainly in certain sectors, particularly, I know Katrina's touched on construction. The professional indemnity market is still very difficult, along with the transport marketplace, mainly driven by the rising costs in credit hire. With the new protocols, the government seem to have got a grasp on terms of the injury side of large claims, but the credit hire claims are certainly spiralling out of control. In terms of the skill shortage, that's another issue in the insurance market as well as the construction, not only for insurers, which is obviously having an impact on the service levels, but also locally. So one of the biggest issues with insurers, sort of going back to Paul's point, is obviously they were taking the premiums and making investments with those premiums. With the investments being at a low, that's obviously had a major impact on their profitability, and when they're getting large claims in as well and not getting the returns on their investments, that's put them in certainly some of the larger players in a difficult place. So, you know, they're all looking from an insurance point of view for marginal increases, and have been for probably the last 6 months. I can see that still continuing. From a local point of view, I think last time I sat at the meeting, we'd had 2 transport clients that had gone into administration and a manufacturing client. So it was fairly negative from that point of view. I think British Steel negotiations seem to be certainly on a more positive note. I think the serious minerals, in terms of the Anglo-American deal, hopefully will have a good effect on this area. And we have a lot of clients, obviously, that are Teesside, North East based, that do rely on as subcontractors to two big industries in terms of the British Steel. So hopefully, if the deals can be put to bed with the Chinese in respect of British Steel and in terms of Sirius, that should hopefully have a positive effect on the labour market and local businesses, I'm sure of which some are members of the forum, Jonathan, from that point of view. Obviously, the concerns and the negativity is businesses, I think, certainly some that are on the brink will continue, and there will be further administrations during the course of the first 6 months of this year, but hopefully at a slower rate to the back end of mid to last year. The Teesside Airport locally as well, I think, is a positive. And what we've seen recently, we've seen quite a few Dutch firms, because of the connection from Schiphol into Teesside, have invested in Teesside, that are increasing the labour force. They're continuing to do so. So I'm hoping that hopefully the new routes that come out of Teesside Airport will also bring investment, maybe from Ireland or from Aberdeen or from southern regions to the Southampton flight. So I'm certainly a lot more upbeat and more positive than I was at the last meeting. Hopefully from an insurance point of view, returns will improve profitability for insurers, which will have a positive effect on everyone's premiums. And also from a local area, I'm hoping that, you know, the British Steel, the Sirius, and the good news about the connectivity with Teesside Airport will bring positivity. So I think from my point of view, leaving the interest rate as it is would seem the right decision to make, rather than increasing it at the moment or indeed decreasing it.
Okay. Thanks so much, Jonathan. I think definitely kind of as a kind of somebody that operates out of the Teesside area as well, I think the news on the airport and the routes and the connectivity has got to be fantastic news for the region as well, so I'd agree with that. From the society's perspective, I guess looking at the mortgage market, we have seen the mortgage market kind of in society, the volumes that we're seeing quieten, I guess, at the kind of tail end of last year and into this year. I guess there's a seasonal impact there, that is something we would traditionally see, but I think some of the uncertainty around an election and then the kind of 31st of January as well is probably something that have added into that and probably suppressed volumes a little bit. I think we are hopeful, shall we say, that as we move past that deadline and people kind of, I guess, start to get to the point of looking at homes and so forth. Everyone talks over Christmas and makes decisions about moving home. Very few people get to actually move home on the 2nd of January. It obviously takes a little bit of time. So I think we think that will pick up, and we're certainly seeing some lenders kind of adjust pricing to kind of try to react to that, as it were. It's definitely a very competitive market. I think on the savings side, continues to be a very difficult market for people, as it were. The savings market for a little while now is one whereby the returns haven't been great. I think, Graham, you touched on it, with people that are obviously on fixed income and pensioners, that is difficult, and I know as a society we look to try and find the areas where we can protect those rates for as long as we can, but it is a challenging environment, shall we say. So I think that's been a really good update from everybody, so thank you. I think kind of to summarise some of those points, we've obviously talked about the fact that the MPC members have generally, I think before kind of their lockdown, been talking about a rate decrease, but we've also talked about the fact that some of the market information we've seen since then has been quite positive and maybe reducing the likelihood of what they talked about prior to their lockdown, as it were. I think we've talked about the economic metrics that we've got to look at, and I think Paul, you kind of summarised that quite well and talked about the fact that there is a mixed picture out there. I think there's probably across the table some differences on how to interpret that mixed picture. It's whether or not you kind of look at the more positive parts of it and say that the underlying data is strong, as it were, with some exceptions, or I guess take the opposing view that there are weaknesses still there within the market. Is there anything else kind of, I guess, on that macroeconomic environment that anybody wanted to add to before we take a vote?
Can I share a little anecdote? It won't take long, but you've talked about housing and you talked about the Dutch. Yeah. I was walking down Yarm High Street 2 weeks ago, and I had my business suit on. I was dressed with a tie, not scruffy like today. And another gentleman was walking down the high street, very smart, and he stopped me. And he says, "Excuse me," his Dutch accent, that's all I'll tell you, "I'm coming to relocate here for my business." I don't know what his business was. And he said, "Tell me about the area." And I gave him the most fantastic advertisement for the northeast of England, Teesside and Yarm in particular. And he asked me about the schools, and he asked me about the shops and so on. And then he asked me about housing. And I said, well, very nice housing, this is a nice area to live and so on. He said, I don't know whether I'll get the housing for my budget. I said, well, what's your budget? He said, well, my company's letting me rent for £12,000. I said, well, £1,000 a month, you'd probably get a family home for that. He said, no, he says £12,000 a month. Exactly.
Wow.
I've just been really interested. Why people see how I do it. I'll have to send him across to you.
Yeah, you don't have his details.
Yeah, but I guess it's anecdotal, but it's a very good example.
When
isn't
you
it?
get in
Money is
investment coming
into
in,
it.
people don't always look at it in the same way we look at it.
Yeah.
And it can have a big ripple effect.
That'll be quite a rental, that, won't it? Okay, so with that, I'll ask people obviously to kind of raise their hands in the traditional form as we kind of look to take the votes. I think first off we'll maybe look for votes for an increase in bank base rate. Graham's talking.
I'm hovering, I'm not going to go for it.
And then I'll take a vote for rates to be maintained month. And then for the rate to be decreased. So I'll vote all. Okay, so thanks very much everybody for your time. Lively and interesting discussion as always. And we will see everybody at the next MPC meeting. Thank you.
Thank you.
Thank you.